Hey! Hi guys, and welcome to Macro Markets. This is Marcel Pechman, analyst and writer at Cointelegraph. Today is Friday, April 7, and we'll be discussing the impacts of the macroeconomic news and events on the crypto space. We'll start by discussing the gold market, the biggest single tradable asset in the world. At the surface level, everyone understands that the precious metal has been used as a reliable store of value for thousands of years. But what is the $2,000 per ounce, or 28 grams, mean, and how relevant is gold for the financial system? The biggest problem in measuring gold market capitalization is calculating how much has been extracted. It is estimated that 210,000 tons have been extracted over the years, but over some 50% of that is being used in jewelry. So that is how the $13 trillion market cap is calculated. It's a guesstimate. People don't know. And even if they knew the exact number, there's a bunch of gold that's been sitting on vaults or using for jewelry that's not really used in the financial market. But if we calculate gold using the $2,000 per ounce and multiplying by the 210,000 estimated tons that has been extracted, we reach the number of $13 trillion. That is larger than the 10 biggest global companies combined. Amazon, Google, Facebook, Saudi Aramco, you name it. The 10 biggest companies in the world, if you combine their market cap, that's still smaller than gold's $13 trillion. We keep hearing that the US dollar represents 60% of the global central bank's holdings, but that is far from the truth. Those numbers cover solely FX fiat reserves, because gold represents over 50% of the reserves of 12 countries, including US, Germany, France, Italy, Netherlands, Portugal, and Austria. US, by the way, is the leader, with 67% of its foreign reserves held in gold. Out of curiosity, Costa Rica, Canada, Hong Kong, South Korea, Chile, and Uruguay hold almost no gold reserves. But gold doesn't serve exclusively to countries, governments, IMF, as gold financial contracts are widely traded on regular traditional markets. The ETF, or the Exchange Traded Fund, is the most common form for individuals and mutual funds to invest and trade gold. Those instruments, the ETF, are supposedly backed either by physical gold or a derivatives contract that is guaranteed by having the equivalent weight in gold. So what's the total size of the gold ETF industry? 220 billion. 220. That's equivalent to 40% of the entire Bitcoin market cap. Okay, so by now it should be clear that gold is an extremely important financial instrument, despite its major setbacks, including the lack of transparency. So we don't know how much gold is out there. We can't precise how much gold is extracted. Gold is not really portable. You cannot use it for day-to-day trading. I'm not even talking about buying a coffee. I'm talking about buying a house, buying a car. You just can't do it, because checking if the gold is 100% pure is not something that is easily accessible and ready. So for cryptocurrency investors, especially Bitcoin holders, only time will tell if gold investors and traders will realize the risks in holding derivatives contracts or financial instruments that may or not be fully backed, because there's no way that they can verify if the gold is really sitting there on the bank, if the gold is 100% pure. It's not easy, it's not accessible, and you rely on third parties for that. But one thing is for sure, if gold continues to rally, miners are hugely incentivized to boost production and also to reopen mines that were previously unprofitable. Because if the gold price continues to rise, those mines that had been shut down 50 or 60 years ago because they were no longer profitable will be reopened. So the higher the output, in turn, tends to negatively pressure the price. That doesn't happen with Bitcoin, because if there are more miners out there, the adjustment difficulty that happens every 2 weeks, roughly, will automatically adjust this, so make it more difficult for miners, so that the quantity, the output of 900 Bitcoins per day remains intact until the next halving, which should occur in a year, where the daily production is cut by half. Now, on to the next topic. We discuss whether the debate on the US dollar losing its global reserve status makes sense. Looking merely from the perspective of base money, meaning the amount deposited at the central bank plus the physical notes, the US dollar ranks third, behind the Chinese yuan and the euros from the Eurozone. Even Japan's yen, an economy that has been dwindling, hasn't grown for the past 2 decades, has a base money very similar to the United States at $5 trillion worth. However, the US banking system has a much higher leverage, so the number of the base money multiply almost by 4 in terms of certificate of deposits and money market instruments, so debt. So the US M2 goes from $5.4 trillion to $21 trillion. So that's what makes the US economy and the US dollar so important. Other example includes the stock market. The NYSE and the Nasdaq combined represents 43% of the global market capitalization. In contrast, Chinese markets, a little bit more than 10%. Another reason for the US currency to be the global leader is the US treasuries, the debt issued by government. Foreign investors hold $7.3 trillion worth of those instruments. Those include $1.1 trillion held by Japan, $860 billion held by China, and $670 billion of US treasuries held by the UK. So US government debt spread all over the world, and those countries depend on the US Treasury, on the debt being paid to compose their international global reserves. So for the third and final part of our show, I'd like to show you a chart of the Federal Reserve balance sheet, which means the total assets held under the Federal Reserve. So the chart starts in January 2010, so before the COVID crisis. The assets held by the Federal Reserve were sitting at $4.2 trillion. And during the COVID crisis, those total assets ballooned to over $7 trillion and continued to escalate throughout April 2022, reaching a peak of $8.9 trillion. So the Federal Reserve was essentially injecting more money. It's similar to printing US dollars because it was injecting liquidity on the markets. They were buying ETFs, they were buying debt instruments, including US treasuries or mortgage-backed securities, MBS instruments. And that's what caused inflation. But they reverted that trend from mid-2022 right until a couple of weeks ago, by March 8th. That's when they started to buy back MBS, debt instruments, and give credit to the banks. So they reversed the trend. So the assets that previously peaked at $8.9 trillion and declined in about 8 months to $8.3 trillion started to go back again to $8.7 trillion. So from one side, the Federal Reserve was raising interest rates. In the last meeting occurred in March, they also raised by 25 basis points. But at the same time, they were injecting liquidity on the market. So one effect like cancels the other. So they are trying to say, hey, no, we're holding back the economy, we're deeply concerned about inflation, but on the backstage, they are giving additional credit to banks, they are buying market-backed securities and debt instruments and ETFs. So they're trying to calm the markets because of the bank crisis that happened with Signature Bank, with Silicon Valley Bank, with UBS and Credit Suisse. So the Federal Reserve is getting lost in the inflation control. They cannot continue raising interest rates and selling assets. They caused a deep recession by doing that. The market was expecting a pivot, so a reverse in the interest rate trend, which was going up. Market was already expecting that by the middle of 2023, the Federal Reserve wouldn't be able to increase rates any longer. But the Federal Reserve is like cheating. They're injecting liquidity on the market, as you can see by its balance sheet expansion, so they can further increase interest rates, maybe for the next couple of meetings, maybe up to 5.75%, but it doesn't matter, because as long as they're expanding the balance sheet, they're incentivizing banks to loan, they're incentivizing credit. The overall trend for inflation will continue to edge higher unless there's a bigger recession out there. So there's two paths going forward. Either we get a big recession or we get huge inflation. And there's a risk, which is the worst of all, of stagflation, which is the recession coupled with inflation. Either way, the Federal Reserve is getting their hands tied. They cannot both raise interest rates and stop inflating the balance sheet. It causes a large recession, it causes bank runs. They've seen the effects of doing that. So I do believe that for 2023, for the remaining of the year, the outlook for Bitcoin and cryptocurrencies is positive. So even if the inflation data goes down for the next couple of months, you shouldn't worry, because that's a sign of recession. If the central bank, if the Federal Reserve continues to buy assets, it shows that they have a weak hand. They're being forced to hold back the market and to ensure that the banks aren't going down. So the financial system is starting to show some cracks. And that's excellent opportunity for Bitcoin and cryptocurrencies to prove itself as an alternative store of value, mean of exchange, and as an alternative financial system. Well, that's it for today. Hope you enjoyed the show. Remember to like and subscribe the new Cointelegraph Markets and Research YouTube channel.